Okay, and you're all being recorded. So awesome. Andrew, how you doing today?
I'm doing well.
Awesome. Awesome. Really
Glad
good
to
to
be
have
here.
you. I see you got your surfboard behind you. You've been surfing it all lately?
This morning, in fact, yes.
Nice. Nice. It's not just a prop. You actually are
No,
getting
no,
a
that
chance
was
to
on
use it.
that board. So, yep.
That's awesome. That's awesome. Well, great to see you. You look good. And like we've talked really in person through COVID, so it's good to be able to connect and good to have you back. So I think we had you about a year ago. I think right after COVID started, right? And you did a
Yeah,
virtual one.
I think it was right before. And yeah, I'm used to bumping into you at conferences and stuff. So,
Yeah, awesome. Well, it's great to have you back. I always appreciate your candor and talking about stuff. I've also appreciated your background and love for you just maybe take a few minutes and just introduce yourself a little bit, help us get familiar with you and your background. I think your story is very exceptional, and so I'd love to just a lot of people are thinking, how can I make the transition out of the corporate world into full time real estate? And I just love to maybe you could just kind of start talking a little bit about your background.
yeah, I took the standard path into real estate, and like you said, went and got a chemical engineering degree. I knew in high school that that's not what I wanted to do. I wanted to do my own thing, but I had no idea what my own thing would be. So I figured if I got an engineering degree, I would at least have a decent job until I figured out what I was going to do for real. Worked as an engineer for 7.5 years. And then my wife and I tried a bunch of different little businesses that, made a little money here and there, but we quickly realized each time that it was just another form of a job. And then we discovered flipping houses here in Southern California. This was late 2006. And what we learned was, okay, contact people who are in pre-foreclosure, meaning they're late on their payments. The bank is threatening to take the house, but it hasn't happened yet. And that involved knocking on doors and cold calling people and trying to help them save their house. But then if they couldn't save their house, ideally they would be like, well, hey, you've helped me out, and will you buy it? And so basically, I went into a business that required me to make cold calls. I was an engineer. I was not good on the phone. It took me 4,576 calls to get the first deal. 6 months,
Wow.
6 months of working full time at my job, and then working full time making those phone calls.
Wow.
But that first deal, when we flipped it, we made as much as I made all year at my job. And we said, all right, I don't think there's any better sign than that. So I walked in and quit that job that I had gotten a 4.5 year, engineering degree for. And it was 10 minutes from my house here in Orange County. And it was, I wouldn't say it was cushy, but it was very comfortable. And I could have stayed there, for a long time.
Real
So it
quick,
was.
Andrew, real quick, slow down 1 second. So I just wanted to so you made 4,500 calls before you made one sale. Did your strategy change after a while? Or was it kind of just the same thing like again and again and again?
Well, so what we did is so my wife would sit there and listen to me on a lot of the calls, and I'd hang up, and she'd be like, "Oh, okay, honey, that was great, but on the next one, try this instead, or use a different tone, or whatever." And actually, and we did hire a coach too. So like, I'd make notes, and like I'd get objections, and if I got stumped, I'd write that down, and then I'd talk with our coach. I don't remember what it was, maybe once a week or something like that. I'd be like, "Okay, well, what do you say if someone says this?" And he'd say, "Oh, well, yeah, I say this or that." And so just kind of an iterative learning process, over time. It took me an exceptionally long time because that was not my skill set, but I wanted, we believed that it was we knew the process would work if we just executed the process. And so that's how we were able to keep going for 6 months without getting anything. So.
And real quick, what made you want to leave your job? It sounded like from what you said, you had a pretty cush, it was comfortable. It wasn't maybe necessarily what you wanted, but what was the motive for you to
Yeah,
make that
it was a
change?
great job. I even taught my boss to surf, and then so we would go surfing every Friday and come in late. And no one could say anything because I was with the boss. So it was, I mean, it was a great arrangement. But I wanted both my wife and I, we wanted the freedom of working for ourselves. And then when you're at a W-2, your upside is limited, right? If you do a great job, you might get a bonus or a raise or a promotion or something like that. But unless you get like way up into the C-suite where you start getting stock options and stuff, you're really not you're limited by whatever your line item is on the budget. Whereas when you're working for yourself, and particularly in real estate, there is no limit. if you can do one deal a year and replace your income, say that's it, or you can do 10 and 10x your income and build, generational wealth and financial freedom and be able to do all the things that you want to do. So that was why, that was the motivation to go in and quit a really good job. And then also, you know, my arms were shaking when I was leaning on my boss's desk, and my arms were shaking as I'm quitting this job. And he was actually really supportive. But, when we sat down and listed out the pros and cons, we said, okay, well, the upside is this works. And, we become much wealthier. We have freedom. We work for ourselves. I have been working from home for 13 years now. And the downside is, oh, I could go back to my old job. Right. So I'm like, okay, in reality, as scary as it sounds, the downside is pretty minimal compared to the potential upside. And a lot, if you just evaluate it that way and go down, okay, what is truly the worst case scenario here? Okay, well, I gotta go find another job. As long as you've set aside savings so that you can pay bills for a little bit in the gap, that's really not that bad of a worst case scenario. You just kind of end up back where you were in the first place.
Yeah, that's a great, I love that you shared that, because a lot of times, and when I've thought about it as well, it's like, okay, well, I've got this lucrative thing that I'm doing that's not that difficult, but if I leave, could I ever go back and do it again? I think it's really important, whatever you're doing, to look at, you look at the downside. So if somebody's thinking about leaving a job, there's a really great book by Robert Kiyosaki called Before You Quit Your Job. And it's actually really good because it talks about, like, being an entrepreneur is like jumping out of an airplane without a parachute and trying to assemble one before you hit the ground. And it can feel like that, right? Because
Yep.
now you got all these expenses, like, and you're doing it. And it sounds like with the flip, you were able to do it. Okay. So you did that. Did you do more flips, or how did you get from there to multifamily, or kind of like, how did that go with the flipping?
We did flipping full time for about 4 years, and then in 2011, actually, so we had really good years in 2009, 2010. But we said, hey, this isn't going to last, because by that point, there's very few houses that had equity left, and everybody else was starting to figure out that the flipping thing was a good business to be in, and it was starting to get more and more competitive. And so we said, all right, well, we just had a big recession. So that means we're probably going to have a big expansion. So what will benefit in an expansion? And then we also said, well, hey, all these people got foreclosed on. They can't buy a house for the next 5 to 7 years. So that means they're going to become renters. So we've got an expansion, which means job creation and rising incomes. And we've got a whole new generation of renters. So we said, oh, well, that probably means apartments are going to do pretty well for the next foreseeable future. And so we went, and actually, the guy that was helping us as a coach in the single family, I called him and said, hey, we want to get into apartments. What do you think? He's like, yeah, actually sounds like a really good idea. I said, well, do you know anyone that we could learn this from? He's like, actually, I do. He connected us with a guy who had done about 800 units. We hired him as a coach. And he helped us learn the process and kind of held our hand, and then we went in 2011. We went and did our first deal, was 92 units out in Macon, Georgia, on the other side of the country. And so then went into apartments full time. So.
Wow. So you made that transition. You saw there was some change coming, and you positioned yourself well. And from since then, 2,100 units. That's really impressive. So talk to us a little bit about, obviously, flipping houses to multifamily, and that. So your first deal was 92 units. Did you raise all the money for that deal as well?
By the skin of our teeth. Now keep in mind too, that was 92 units in 2011. So we paid 7,500 a door for that. It wasn't, and it was in a low income part of Georgia that I would never ever buy in again, and I would tell everyone else to run away from. So it wasn't, as it sounds like a massive deal, but it wasn't. It was, the total capitalization was like 1.2 million. So that's purchase price plus reserves plus renovation. But we did significantly underestimate how hard it would be to raise that much money back in 2011, because number one, a lot of people were still terrified of real estate back then, and we hadn't fully built out a network big enough to raise that. Also, we had two investors who told us they would each put in 400,000, and we did not vet them well enough. It turns out one guy never had the money; he eventually declared bankruptcy, and then the other guy had the 400, but he wanted to be a full equal partner, and we said, no, that's not what we're doing here. So we ended up taking us 6 months to raise the entire amount. We ended up getting the seller to carry a note for 200,000, so that we could at least get things closed. And it was quite the learning experience. And like I said, we barely made it. It was 6 months of, everyone we knew, and then who do you know, and then who do you know, and but we got it done, and it ended up as a good profitable deal. And without it, we wouldn't be here today. So.
Yeah, so that's amazing, and you just really continue to scale. I think one thing I admire about you, Andrew, is that you've just continued to learn new things. Like here, you're an engineer, and you're like, I'm going to flip houses, I'm going to do that. Then you own a multifamily. Okay, we're going to figure it out. We're going to figure out how to raise money. We're just going to kind of keep going. Did it get easier after the first deal? Did the second deal come along pretty quick after that, or?
Yeah, multifamily is very much an unfair business. The
Mhm.
longer you're in it and the bigger you are, the easier it gets. It's the hardest at the beginning.
I agree. I think that's our friend Michael calls it the law of the first deal, right? Like you get your
Yep.
first deal done. And until then, I mean, it can take you up to like a couple of years of really pushing. And then you get a deal done. And all of a sudden, like you're getting, the brokers that wouldn't return your calls are like calling you, like offering you a deal. And they're like,
Yeah.
you get people saying, hey, can you come and raise money for my deal? Or can you come and do that? Like, it's just amazing kind of the stuff that happens and things that open up. Um, so talk to us a little bit about your approach. And I think one of the things you've mentioned to me is like you use data in a really unique way to be able to identify properties. I think you mentioned that you'll get the data on certain sizes of properties in certain areas. And then you'll ask the brokers, do you know these owners? And you'll can you maybe talk a little bit about how you find or have found some of your deals in the past?
Yeah. I mean, it used to be in 2011, it was like shooting fish in a barrel, right? I mean, we used to just, I'd say, okay, I'm coming out in 3 weeks, and then line up like 20 properties to tour and be like, okay, I want that one, right? Whereas now, I mean, sometimes you've got 24 hours to put an offer in on something, whether you've seen it or not. So, most of our deals still come through broker relationships off market. But getting back to what you alluded to, kind of flipping that around, what we'll do is let's say a broker sends us a deal in, Gainesville, Georgia, which is a nice suburb, to the northeast of Atlanta. And we look at the deal, maybe we put in an offer, maybe we don't, we get outbid, whatever, that deal just doesn't work out. But in the process of looking at that deal, one of the things you do is look at the rental comparables in the market, right, to see if there's any upside in rents or anything like that. So then what we'll do is we'll take so when we look at those comps, let's say there's 6 of them, we might say, hey, these 3 comps, we wouldn't mind owning these. So then we take those 3 and we call the broker, say, hey, we understand that Creekside Apartments is under contract, but hey, what about these 3 other properties in the same neighborhood? Do you know these owners? Can you see if they're willing to accept an offer? And 90% of the time, the broker's willing to go check it out, right? Most of the time they already know who the owners are, and they're like, oh, that guy just refinanced. Oh, this guy, he yelled at me the last time I called him, and this guy might take an offer. Let me reach out, right? So we haven't actually closed a deal that way, but we have put in offers that way, where basically instead of the broker bringing us the deal, we bring the deal to the broker. And then recently, we've actually just 2 weeks ago, we brought on a person where we paid for a service called Reonomy, which it's only a few $100s a year, but you can basically get any kind of property list you want. And then he is cold calling owners of properties of all sizes, from 20 up to 300 units, and seeing if he can find somebody that is interested in talking with us about selling or looking at an offer. And we just started that 2 weeks ago, and I think we've talked to like 4 owners or so. So those are a couple of things that we're doing now in today's market to try to dig up deals.
So there's a question coming in, and Mark was asking this, and I think it's a really good question. That the idea of what an off-market deal is. It's interesting how multifamily, and you shared this, that it's not a fair game. It's not like it's a fair thing. For example, we just had a deal at Oklahoma City that one of our partners basically has 2,000 units in Oklahoma City. And because it's a very competitive market, but because of this unique situation, because of a relationship with a broker, that my partner was like the only one invited to the table to like make an offer on this property, versus if you go out to the market and something is publicly listed or it's more listed widely, it could be 20 to 30 offers. And can you talk a little bit maybe about why that happens? Like why if I was an owner of that property, why would I want to stay off market versus having as much exposure as possible?
Yeah, and it's funny. I mean, off market is a very loose term. Sometimes that means that the broker only sent it to 10,000 people of their 40,000 person list, right?
Off market.
True off market is they called their top 5 people, which hopefully you eventually become one of those. But the reason a lot of owners do off market is, there's a handful of reasons. I've even sold stuff off market. Some reasons are, a lot of times if it's not managed well, the marketing process can disrupt the property. Sometimes the staff and the tenants will leave because they're worried, especially the staff, they're worried about their jobs. Or if they know it's going to be sold, they don't really care anymore. And so performance starts to go down. So that's one reason that a lot of times it'll get kind of shopped around off market. Another is sometimes people just have a number in mind, and if someone can come along and hit that number, they're good with it. And that's another reason that they sell off market. The one time that we sold off market. Oh, and then I should really clarify here. Just don't think that off market means good deal. A lot of times it's actually the opposite.
That's
A lot
true.
of times another reason it's off market is because the seller wants such a crazy high price that the broker knows it's a waste of their time to market it, but they'll still send it out to their people on their list just to see what happens and call it off market. And that way, hey, if they put together a deal, great. But if not, hey, no big deal. They didn't waste their time. So sometimes off market actually means it's a terrible deal. But yeah, those are some of the reasons. But like, we sold off market one time. We had a property in Dallas, and someone came in and offered us our 5-year price target, basically at like the 2.5 year point. And we were kind of already, that it was a high headache property, and we're like, hey, you know what, let's just we negotiated a really low commission because the brokers didn't have to do anything other than just connect us. And we said, I think it just makes sense to get out of this one early, and we went ahead and did that. We're selling 2 properties now, and we're going through the full marketing process. But again, yeah, it's different circumstances arise.
Yeah, and that's the amazing thing too, is it's everything is for sale, and so we've got a property like that. We're about 2.5 years into a 5-year hold, but it's like we're getting a really good price, and so everything's for sale, and it's all, if you can get higher investor returns and you're able to do it, it makes sense to sell off market. But yeah, I think a lot of people don't realize this, particularly in the larger multifamily, that a lot of the stuff goes off market, and it's not just like, oh, you have, but even with single family, this takes place too, right? Like you'll have,
Mhm.
that's why wholesaling and other things actually exist, because they're unique circumstances. But um, can you talk to us a little bit about what you do to educate yourself, Andrew? I think you're somebody who really does a lot of study as far as what's happening in the market. Can you talk maybe about some of the resources that you peruse to kind of help educate yourself on what's happening both in the economy as well as in multifamily?
Yeah, I'm a member of multiple different masterminds. A couple that are multifamily specific, and then a couple that are more general business and wealth oriented. I listen to my goal is a minimum of 730 podcasts a year. The vast majority of those being real estate focused, and then I try to surround myself with as many other investors as possible. And there's certainly cases where I try to make myself the least experienced person in the room. But at the same time, I was having a conversation with somebody yesterday who I think, he'd done like two properties in the 20 to 30 unit range, and he mentioned something. I was like, that's a great idea. I don't know why I'd never thought of that. And so now we're going to go do that, right? So really try to spend a lot of time just talking with other people who are in the multifamily space. And what I found is you can learn something from almost every experience level. It's great to talk to somebody who's done 10,000 units, but it's also great to talk to somebody who's just done their first deal and is fresh and has new ideas and is just getting into the business. So yeah, and then of course a ton of different newsletters and market reports and all that kind of stuff.
So let's dig in a little bit more there. So what are you seeing as far as, like, I guess maybe just talk a little bit about how your business was affected by COVID and kind of what you see kind of happening as far as in the near to midterm future as far as multifamily or as far as investing opportunities. I'd love to hear kind of your opinion on that.
Yeah, when COVID hit, we sat down like, oh crap, like how we literally, because they shut everything down and said no one can go to work, and so we literally made a spreadsheet and said, okay, if 50% of our people pay rent, how long can this property last? Well, this one can last 6 months. This one can last 9 months. Oh, this one will last 12. That's good. Before we can't pay the mortgage or whatever, right? Based on reserves and all that. And so that's what we did when all the shutdowns started. And the exact opposite of that happened. 2020 ended up being the best year we'd ever had, and 2021 is way ahead of that. Basically, we chalk it up to number one. Most of our properties are B class, so they were not. Most of our residents are not the C class, where they are working those jobs that can't be done from home, or that got severely affected by COVID in the shutdown. So I mean, I know of people who have properties that is what happened. They immediately dropped 30-40% in revenue. Fortunately, that wasn't our demographic. So, and then what happened is people were stuck at home. They can't spend money on movies, on going out to eat, vacation, anything. So they're like, okay, we're in the middle of a pandemic. The last thing I want to do is get kicked out of my house. So everyone paid rent. And then then everyone got stimulus checks and all of that. So what that ended up leading to was the best year we'd ever had, like I said. And then now, as we're coming out of COVID, there's more stimulus. Everyone's going back to work, and then there's substantial savings, and there's so much demand for housing that we're seeing some of the fastest rent growth we've seen in a decade. So.
That's awesome. Yeah, no, I think we had some big concerns as well, and we only had one property where we saw some COVID delinquencies, but it was very minimal, like 2% of the 2 to 3% of the residents was very minimal, and so didn't have a big effect. And now we're just seeing huge, prices. Everything's rents, prices, everything's going up a ton. So let's talk a little bit about inflation. I mean, do you have some opinions on inflation and kind of how that affects both from an investor standpoint as well as an owner standpoint of owning multifamily?
Yeah, I mean, real estate is definitely one of the best inflation hedges out there. Although I will say a lot of people assume that interest rates and inflation are the same thing, and that's actually not the case. I mean, I like right now we have raging inflation, right? I mean, just lumber, I mean, gas, everything has gone up multiple times over, but interest rates are still super low. The 10-year treasury is only back to where it was before the pandemic, which was at that time like a 35-year low. So we still have basically all-time low interest rates, the 10-year at like 1.6 something today, and the Fed funds rate at effectively zero. Yet we have significant consumer inflation. So they actually really are two different things. Cap rates. So even though inflation is going up, cap rates have been coming down the last 6 months. Every time we turn around and say they can't go any lower, we're completely wrong, and they go even further, right? Almost everything we look at for class C, B, A minus garden style properties is going for something in the 4 range in Georgia, Florida, and the Carolinas, which is absolutely nuts. That used to be what you'd see in LA or San Francisco. Going forward, it's hard to not see some increase in interest rates. how significant it gets is tough to say. Do we do we get and I mean, so as far as inflation goes, when it comes to the cost of materials inflation, wage inflation, all of that stuff is good for real estate because it drives rent up. And the more expensive lumber and copper and steel gets, the more expensive it is to build new properties, which means they have to charge higher rents, which means the rents at existing properties that all of us already own gets pulled up, right? So all of that is good for real estate, and especially multifamily. The one negative would be if interest rates, and primarily the 10-year treasury, if that gets high enough so that commercial mortgage rates rise significantly, then that means either one of two things has to happen. Either prices come down so that investors can still get the yield that they're looking for, or investors will have to pay the same prices and accept a lower yield because that debt service is going to be that much more expensive. So that's what we're really watching is not inflation in the sense of prices and costs and all of that, because that's actually helpful. It's interest rates. And you know what, I can see interest rates, the 10-year treasury is what commercial mortgages are based off of. That's why I keep referring to that. Today it's at 1.6. I could see it maybe at 2% by the end of the year. After that, I'm not convinced that it goes skyrocketing upwards. It certainly could, but once all of our supply chain issues get sorted out and the world goes back to basically the way it was, we were in a massively deflationary environment beforehand. And yes, we've printed a lot of money, but the entire world has printed a lot of money. So every country, again, is kind of in the same boat. And money supply is not the same thing as interest rates. So sorry to dive deep into the pool, the economics pool, but that's kind of my thought on it. Is I think we definitely have a moderate rise in rates coming, but after that, I could see it going either way. I've heard great arguments for why we're going to have raging inflation and high interest rates. I've also heard really good arguments as to why the current inflation is temporary and will go back the other way in a few years. So what do? Buy real estate that cash flows, be able to hold it long enough. And that's one of the best things about real estate. As long as it cash flows, you can hold it forever and you will always win in the end. So just make sure you structure it cash flows and you structure your debt properly, and you don't have to worry about all these, oh gosh, which way does it go? So
Andrew, I'm actually grateful for that. I like economics conversations, so I'm always happy to hear somebody's opinion on the economics, because I think it's important that people, having been through 2 cycles, I've learned very personally that all ships rise and fall on the tide. And whether we like it or not, right? We're not big enough investors, and I don't even think that big investors are big enough to be able to duck that it all rises and falls on the tide of the economy of the U.S. as a whole and on the region that you're in. And so I think it's important that you took the time to differentiate between the interest rate that you're paying on the note on the units you're looking to purchase versus the inflation rate actually pushing up costs of things, which will push up wages, which pushes up people being capable of paying rent, and will push up commodities. And real estate is a commodity. So I think it's important that people understand that difference. So thank you for taking the time to do that. That was not off topic at all, in my opinion.
I thought it was really good. I think too, it's interesting, the time of high inflation that we've really had more recently was back in the late 70s and early 80s, where it was, up to 15, 20% annually. And they raised inflation to try to kind of cool things off, or to basically, make it so that the economy didn't overheat. Correct. So basically you have, a time that we're just waiting to see. I mean, I've heard if you use the CPI from the 1980 metric before they changed it, it was actually much lower. I mean, I'd love to hear your input on that, Christina, but actually it could be that inflation based on those metrics now is actually above 10% already. But then again, it's again, if things, I'm just curious, obviously there's a lot of money that's out there. And, we have an event coming up in about 3 weeks, 3 weeks from today, actually, on this topic with some well-known people talking about inflation and just trying to figure out, okay, where is this all going? Like, what's all happening both in the short term, midterm, and long term? And at the end of the day, as an investor, whether you're active or you're passive, you should really be asking this question: where do I put my money right now? What should I be doing with these resources? Because if inflation does pick up substantially or it doesn't, I mean, those both have significant impacts on what you should do. So it's something that everybody, I think, should be really interested in and have an opinion on and continue to learn on. So appreciate that, Andrew. Any other trends that you're seeing right now in it sounded like you're saying inventory and offers. Are you finding, as you're selling these properties, are you finding places to kind of like do new deals and roll this money into? Or are you guys kind of sitting on the sidelines now? Or what's the plan for the capital that, your investors you have that are kind of cashing out now?
We're not acquiring nearly as much as we would like to, simply because there is good deals are hard to find. There's not Most sellers aren't motivated because they're seeing the same things we just talked about. Rents are going up, cash flow is great. And so there's not a ton of inventory, and there is a ton of capital chasing it. So that's why we're adding ways of finding deals. Like, we're starting to call directly. We're sending properties to brokers and saying, hey, do you know these guys? So we're trying, we're actually ramping up our ability to look at deals. The deal that we closed in March, we have another small one under contract now, but it's not being syndicated. But the syndication that we closed in March, in order to get that deal, we analyzed 347 deals to find that one. And what we're finding is that number is still holding true, and even now. And so we're trying to add capability so that we can if necessary, we can process 500 deals in a couple of months to find another really good one, as opposed to lower your standards and get into trouble down the road. I was talking to a potential investor today, and one of his comments was that he's finding a lot of deals that came out in the last few years are not hitting their pro forma, right? And because people stretching to win the deal, get paid the fees and all that. And so if you're going to be in this business long term, you don't want to do that. As soon as you start missing your numbers on consistently, you're going to lose your investors and get a reputation and be out of business. So
Yeah, that's something we look at too, is really trying to manage expectations. I think when a lot of people start, they think both actively and passively. If you're an active investor and you're raising money, it's like, oh, I want to have a 20+% return per year, or I want to have this super high cash on cash number. And then if you're not able to meet that, though, then you're really not kind of staying true to your word, right? And so sometimes, like a lot of groups that we work with, it's kind of like 14 to 16% IRR. Conservatively underwritten with some upside in there. Sounds pretty good. I mean, it depends on the age of the property and different things. Maybe it's not even that high, but again, you'll see groups that will say, hey, we performed every time, we've outperformed for these reasons. And again, it's that under promise, over deliver. And I think as a passive investor, I think it's important also to not just look at numbers, because numbers can lie. There was a class in college on statistics, and one of the books was How to Lie with Statistics. And it was kind of like, you can make numbers say just about whatever you want. These are pretty big levers on these things. So let's talk about a little bit, to become a syndicator. I think a lot of people here are probably interested in scaling up their business and growing. I mean, you went from, I look at, calling 4,500 people, and I mean, you don't have an aversion to hard work. You're willing to put in the work and the time and the effort. But what advice would you give to somebody who's kind of new or starting out, saying, hey, I'd love to do what you're doing, and how do I get going on that? How do I get my first deal? How do I get involved? What would you say?
Yeah, I'd say 5 things, or maybe five bullet points on that. One is just accept the fact that it's going to be hard. It is not easy. If it was, then you wouldn't be able to make a ton of money doing it. It's going to be hard. It's going to take a long time, especially in the beginning. It's going to be frustrating. You're going to wonder if you're ever going to get a deal or ever be able to raise enough money and all that. So just accept that and be okay with that up front, and know that the longer you do it, the easier it gets. Like I said before, it really is an unfair business, because the more you've done it, the easier it is. Where it would be nice if it was a little easier in the beginning, right? The second thing is decide exactly what you want and what you're trying to do. I see a lot of people who are like, oh, I'm looking at this multifamily deal, and then my friend has this really profitable laundromat, and self-storage is awesome, and mobile home parks. Oh, I heard Brendan Turner's doing that, so I'm going to look at those too. And it's like they're just all over the place. All of those things. Oh, short-term rentals are super hot right now, right? All of those things are great if you focus on one and get really good at it. But if you try to do all of those things, you're never going to be successful at any of them. So now that doesn't mean you certainly can get really good at one of those, get an established business, and then start adding some of those other things to it. But in the beginning, decide what you want. Are you looking for a 10-unit apartment complex that's in your neighborhood, or are you looking to go for 100 units in any market across the country that is good, right? So decide what you're looking for, focus on that, get really good at that. And then the next third thing is and I just alluded to this, is pick a market. Decide, okay, if I know, obviously I live in Southern California. I do not invest in California for multiple reasons. Very business unfriendly, way too tenant friendly, and cash flow is terrible, among other things. So, we picked the Southeast United States because you've got great job growth, great population growth, great income growth. It's either very balanced between landlord and tenant, or it's actually a little bit more landlord friendly, right? So we said, okay, we're going to go to those markets. So once you've decided what kind of property you're going to get, go pick a market. And again, that can be close by, that can be far away. Definitely don't let geographic proximity be a limiting belief or a limiting factor. You're much better off picking a market where you're going to get the returns and types of properties you want. And if you can work it in, pick a market that you want to visit anyway, right? So if you like to ski, Salt Lake City is a great place for apartments. If you like the beach, Florida Panhandle, Jacksonville, all those places are doing really well. And I say that tongue in cheek, but we've got 400 units in the Florida Panhandle, which means I have to go to the beach at least once a quarter to go visit the properties, right? And it's a legitimate business expense. So that's not too bad. And then once you know what kind of property you're looking for, once you know the market that you're going to do it in, start putting together your team. And this doesn't have to be an overwhelming thing, like, oh geez, I got to hire this person or anything. Team basically just means the people that you need to start your business, right? So that's going to be some brokers. You're going to go to the big brokerage house websites and just find out who's listing properties. Go to LoopNet, not to find deals, but just to find out who's listing stuff, right? So start talking to brokers. When you start looking at deals and properties, assuming you're going to do third-party management, which I would recommend, ask the broker, say, hey, who are the top 3 companies that if you were buying this deal, you would hire to run this property? Get their recommendations. Ask all the brokers that, build a list, interview those companies, narrow it down so you have 2 that you would want to work with. And then again, do the same thing for contractors. Ask the property management companies, hey, what are your favorite contractors? Talk to other investors. Other investors in FIBI meetings, go to like Bigger Pockets forums and say, hey, I'm investing in Atlanta. Do you guys have any contractors you can recommend or that you trust or that have done well? And then once you've done all of those things, once you've said, okay, this is not going to be easy, but I'm going to stick with it for 12 months until I get a deal. I'm going to look for properties that are between 10 and 20 units and that are built between 1980 and 2010. I'm going to do it in Atlanta and Nashville. And I started talking to brokers, and I'm going to use this management company. Once you've done all that, the last thing is to just relentlessly pursue it and just keep going and executing until you start getting those deals. Once you get the first couple of deals, it gets easier and easier and easier. So,
it's interesting, Andrew. I look at you as kind of being like a superhero, where you've kind of just like done everything. I mean, you've kind of like just taken the bull by the horns and gone for it, and like, I mean, I know you have some team that helps you and does different things and whatever, but it seems like you're just like involved on every single level. And to me, like, I invest passively. I also am involved on the levels, but I'm not the primary asset manager. I'm not finding deals. Maybe I'm more on the capital side, but Yeah. Would you suggest that somebody focuses more on, because I know a lot of people are talking about this, do you focus on kind of finding the deal and operations, or do you focus more on finding the money and kind of being involved in that side? Or do you say you just, hey, try to do everything and do it all at the same time? And just by doing all raising money and finding deals and operating deals, like you're going to kind of figure it out along the way.
Well, that was actually one of my biggest mistakes, was being too involved in everything for too long. When you're starting off as an entrepreneur, that often is the case, right? You wear every hat, and to some degree you want to do that so that you can manage or supervise someone else that you bring in to eventually do that for you. But yeah, that was one of my mistakes is waiting too long to bring in, there's those two types of team members, right? There's the team members I just talked about, like the brokers and attorneys and all that. But then there's team members like, okay, hey, you're going to raise money. I'm going to focus on underwriting deals, right? That's a partner, another team member, or even a virtual assistant, or, that's kind of like what I would say is internal team members. If you, you know, ideally, a lot of people are really good at money raising, and or even if they don't know anybody already, that can invest, they're just, someone who can walk into a meeting full of strangers and just, at the end of the night walk out and know everybody, right? That's someone who could be a good money raiser. That is not me, right? I'm really good with numbers and spreadsheets. And so after that, so going back to our first deal, after that almost killed me, trying to raise the money for that, I went to my mentor and said, hey, if I find another good deal, are you open to working together? And he's like, yeah, we get along great. We'll do that. Right. So for the next two deals, him and his partner raised like probably 70% of the money. Then by the fourth deal, a couple of my investors came to me and said, hey, we don't want to just be investors. We want to be partners. How about you focus on operations and we'll help expand the network of investors? And I'm like, deal. Right. And so they basically helped bring on the investors for the next couple of deals, and then it just snowballs from there, right? So when I started, I would be thrilled to get one or two new investors added to the list a month, and now 4 to 10 a week just show up on my calendar. I don't even know where they're coming from until I ask them, right? And again, it's unfair, but the reason that happens is because I've been doing this for over a decade now, and it kind of snowballs and grows. So, but again, the way by yourself you can go fast, but as a team you can go further. And so if you can find a partner that can either do the money raising or deal finding or just some other aspect, definitely do that. It makes it easier and more fun and a little less lonely to at least have someone to commiserate with. So.
Yeah, so I think this is really important because I think a lot of people, myself included, were like, "Well, how do I get started?" It feels overwhelming. It feels like eating the elephant. It's just so much. Like, what do you do? And so for me, I started out. I was actually looking for deals. I was trying to bring deals, and I was trying to bring deals to well-known operators and just try to get in that way. And then it's funny, my background is sales. I have like 10 years of sales experience. I got all those people that I know, and then finally I was able to raise some money for a deal, and it was like, oh, that kind of worked out. And then I was able to kind of have this partnership and raise a bunch of money. But it's just, I would say if somebody's looking to get started, just think of yourself. Are you the people person that loves, could you be on the phone having 20 investor calls in a day? I mean, I've had those days where you're just talking to people back to back. And even sometimes if you're not feeling well, even for me, like that's kind of a tough, it's a tough day, but you do it. But then there's other people like yourself, Andrew, that are a little more kind of numbers and show me the deal and can kind of sit with it and really like enjoy that process as well. And so, and not that you can ignore the other side, but I think having team and having partnerships can be really helpful. So so let's talk about that real quick, for you, even though yeah, I guess you said like raising capital is coming easier now, but what would you say, like what do most of those investors say of like, hey, here's how I heard about you, or here's why I want to give you $100,000 even though I've never met you? Like, how do people find out about you, and what are the ways to, like, for somebody to start raising capital for deals?
Yeah, and let me tell you, everybody on the call, when that happens to you for the first time, when someone sends you 500 grand and you've never met them, it's kind of
Yeah.
a scary and cool feeling at the same time. But again, so in the, if you're starting out, the best way, the best way to get investors is to attract them, not hunt them down. And what I mean by that is, you know, and for one, those are going to be the best relationships anyway, right? Is the people that naturally kind of are attracted to you versus, you went and tried to sell them on, you forced them to give to give you their email address or something like that. Going to showing up at things like this, talking about real estate. The more people that know what you're doing and know about the opportunities that you are providing, and that's what you're doing. You're not asking for money, you're providing an opportunity. There's lots of capital that needs a return these days, and you're providing an opportunity to do that. The more people that know that, the more people will come to you and be like, oh, hey, well, can I invest? And one of the conversations that I love to have is, actually, I was at a physical therapy appointment today, and the guy started asking me, and so, and you talk to me, oh, this is what I do, and this is, and these are the type of properties, and I do this and that, and I bring in investors, and then say, well, hey, who do you know that might be interested in that kind of investment, right? And so what you do by doing that is, number one, you didn't ask that person if they are interested, so you avoided that whole kind of making people uncomfortable, like, oh shoot, he just asked me if I want to commit to something, right? So you ask them if they know somebody else. So the couple benefits of phrasing it that way is, number one, maybe they do know somebody, and they're like, oh yeah, you know what, my dad is a surgeon. He just retired and he's looking for passive income. I'll connect you. But then half the time they'll go, well, wait, what about me? How come you didn't ask me? Right? So now you picked up two people instead of one, and you didn't make it an awkward situation. So, look for opportunities to talk about real estate, get that conversation going, and use that phrase. And then any opportunity you can get to go on a podcast or post on forums like Bigger Pockets, post stuff on LinkedIn, and just let the world know what you're doing, and try to attract the people and the money and the partners that are going to be a good fit for you.
I think that's a great idea. I mean, you just said, who, I'll let you go one sec, Christina, but who do you know that might be interested in this type of investment? I think that's a great way to ask without asking, and then not make it awkward. And then the second thing that you said, I thought was really interesting. Oh, and one thing I want to say is that a lot of people, I think, at least when I started, they had no idea that I was doing real estate. And so they'll think of you as, you're engineer, Andrew, or you're, medical guy, Bronson, or, they think of you a different way. And so you need to start telling your story. And so one way to do that is through like an active campaign, email marketing thing. Just put everybody, all your friends and family in there, and start telling them the story of what you're doing. And then you can add people on there. And then the third thing is just creating different resources, whether it's an ebook or being on podcasts or anything you can do to create value, because people, when you give something away for free, then the value typically will come back. But Christina, I know you got something you're burning to share too.
No, it's fine. I was about to say the same thing you were saying. I just wanted to highlight, Andrew said it perfectly when he said, let the world know what you're doing. It's like kind of pick whatever platform you like. Like, I'm really great with talking and I'm horrible with writing. So I have a podcast and I don't do a lot of blogs. I let, other people do blogs for me because that's what I'm good at. So you got to let the world understand what you're doing, because if you don't share it with them, then there's no way you can help them. So you have to be willing to be able to reach out and say, hey, I'm the blah, blah, blah gal, or I'm the blah, blah, blah guy, right? I do this, and this is what I do, and I do it well. And I'm happy to talk about it any day of the week, whether it's a stranger in the elevator or whether it's somebody at a podcast or at a meeting. So I think Andrew sort of hit it. Like, it doesn't have to be a particular pathway. It can be your pathway, but tell the world.
And don't be afraid. Don't copy what everybody else is, and don't try to be better than anyone else. Just be different than everybody else, and you'll attract the people that are the right fit for you. That surfboard is not a prop, but there's also a reason it's in the background, right? Because everyone else, you'll see like a nice corporate logo and all that. I'm like, forget that. I'm wearing a t-shirt and there's my surfboard. Right. So and some people are gonna be like, oh, that guy, I'm not gonna, that guy he's not professional. Okay, fine. That person's not a good fit for me. It's okay. You want you want to attract the people that are a good fit for you. And that's how you end up with lasting relationships in the people that either are a great partner or they're going to invest in 10 deals, right? It's better to get one investor who's a great fit and invest with you 10 times than to try to get 10 different investors. So don't be afraid to be different, be yourself. I mean, obviously be ethical, have high amounts of integrity, honesty, transparency, all of those things, but don't try to well, those guys all wear expensive suits, I need to go get one. No, just be who you are. And because people invest with people that you've heard this before, but people invest or do business with people that they know, like, and trust, and the way to do that is just be who you are.
Yeah, the authenticity is huge. I think that's awesome. I appreciate you sharing that, because I think we're trying to be something sometimes that people just want us to be, and I think it's just important you be yourself, 100%.
Well, I mean, and I catch myself doing it all the time. I listen to a podcast. I'm like, oh man, that guy's doing that. I should do that. I'm like, it, you wanna listen to what people are doing and learn from it, but it on the flip side is compare is right next to despair. Like, don't compare yourself to what everyone else is doing. Get good at who you are, what you can do, focus on that, bring in other people to fill in the gaps, and go for it. So
Yeah.
All right. We're going to actually kind of shift to questions now. So if you have any questions, if you can go ahead and drop those in the box there, that'd be great. So we can start taking some questions.
We had
Christina?
one early, Bronson.
Sure.
There was actually somebody who put a question in early having to do with when will rents return? So let me see if I can find it here.
Oh yeah. So Paul's asking, when do you speculate that rent on B-class units in LA will recover to pre-pandemic levels?
Yep.
I don't invest in LA. I do have one rental. It's right on the LA Orange County border, and rents on that in the last 12 months have gone up probably 10%. But as far as the broad LA market goes, I'm not in that market. The challenge with LA is it's so land tenant friendly. That you actually did have situations where you got 10 tenants in a building and 8 of them band together and say, we're not paying rent and you can't evict us. And so LA's got a lot of structural issues. So it's anyone's bet. With that said, there is still a housing shortage, and it will eventually correct itself. So if you've got rental properties in LA and you can hold on to them and keep cash flowing, it will come back. I mean, I don't doubt that in the long term it'll be okay. Exactly when and how in the short term kind of depends on how the rest of this COVID stuff plays out.
Yeah, it's interesting too, because LA, I know there's some friends of mine that have stuff in West LA or Venice or other areas where some of these areas have been hit very hard by people just leaving, just going back to wherever they're from. And so rents have come down there quite a bit, back to Wisconsin or Iowa or wherever it is. So we like to buy a lot I know this is kind of where you do too, but the Sun Belt, basically, where there's a lot of migration in good times, there's migration in bad times. Companies will relocate to these areas. People that are retiring now will continue to move to those areas. So those are some reasons. It's funny, we run this meetup in LA, and then I don't own anything in California, and I know Christina has owned stuff in California, but I'm just like, I don't know, I like it better. The cash flow is much higher, and you can do what you want with your property, and you can actually do value add versus here. It's crazy.
To be accurate, I no longer own in LA either. So we now all 3 of us do not own. I mean, what I've done recently is flips and not rentals in California.
Oh, California is great for flips.
Yes, thank you. That's my opinion too. Appreciating markets are good for flips. Stable markets are good for rent. So my rentals are in Indianapolis, as Alvin said earlier. So, I don't own rentals, and a lot of it is the tenant's rights and the difficulty in just being able to find something that is cash flow positive. I owned my first apartment building in 2004, 2002. Somewhere between 2000 and 2004. I'll have to go back and find the exact date. And I was able to get a 7 cap in the Van Nuys Valley area.
Wow.
And I know exactly. And
probably so 3 now.
I'm silly. I believe that a multi-unit's purpose is to be my cash cow, right? That was in my cash cow column in my investment portfolio, was my, my apartment buildings. And I ended up having two different ones in that general area at different times. And their job was to be a cash cow, and it was not to be an appreciation vehicle. But that market, the Southern California market, and the multi-units in particular, has changed its nature and its tone almost completely. And so now I invest out of state.
Yep.
Well, that's one of the beauties of real estate, and it's you can live where you want to live and then invest where the returns are the best. So.
Well, the other thing too is you can do what you want to do on the properties as well. So like for me, I don't do a lot of asset management. I will go visit properties, but I talk to investors all the time. That's what I love doing. I love being able to kind of resolve things for them. And I will go, initially walk a property. I'll go back occasionally, but I'm not like, you always go out, to the beach every, at least once a month or once in a while to do it. We do have a few questions here. I just want to go to, looks like George is asking, I think this is for Andrew, how did you come up with the idea to have the seller carry a note for you on your first deal? Maybe you can describe that.
Well, part of it was sheer desperation. I mean, we were just like, okay, how the heck can we get to 1.2 million total? And we knew, he only owed like a couple $100,000 on it. So we knew he had the equity. So basically the strategy was said, okay. And truthfully, when we did the due diligence inspections, we found a lot more deferred maintenance than we were expecting, but we didn't want to retrade. So we thought, okay, this is our opportunity to raise some money from the seller. So we went to him and said, hey, look, we did the due diligence. We found a lot more deferred maintenance than we were expecting. We don't want to retrade you on pricing, but this is going to take some extra capital. So how about instead of you lowering the price, you carry a note for a few $100,000. So we framed it in terms of, well, you can lower the price or just carry a note. And of course he said, I'll carry the note. And then so he gave us a couple $100,000. I think it was at 6% interest only. And eventually we refinanced him out of it. So.
Yeah, that makes sense. Yeah, sometimes it sounded like, just to get the deal done, they'll work with you on it. I find these days, it all depends on the seller, right? What's important to them. There are actually people that my cousin who comes and speaks here once in a while, he said, yeah, he's got one in Chico, California. It was this 20-unit apartment complex, and this really old couple that was like in their late 80s, and they basically set up they would pay them a certain amount per year and then buy it fully in 5 years. So it actually reduces their tax basis. So again, if you do it as, hey, I'm trying to help you solve a problem, it actually can really benefit a seller because they don't take this huge, they own it all cash outright or things like that. So there are ways to do it, but it's every situation is different.
And that scales from a single family to a fourplex to 250 units. Our last deal, that's exactly part of how we won the deal, is the seller gave us $6 million at 0% for 6 years.
0%. That's amazing. So you didn't put any money down either?
Oh, no. We still had to put 12 million into it. But I mean, his 6 million is at 0%.
0%. That's incredible. Yeah, but you were solving a problem for him, right? You were saying, I've got all this equity here and I want to just not have to. Yeah, that's great. So you're able to solve it for them. Some of the best people that best investors actively that I've met are really great at just solving problems, really understanding people's problems and solving them. So this question is from Ed. Is one of your goals to buy multifamily for yourself to hold forever?
Yeah, absolutely. There's two ways to build this business. One is to kind of stack it up, right? You buy a single family, you flip it, then you go get a duplex, and then you get a fourplex, and then you go to 10 and 20, and you work your way up, right? Which I've known people that have gone very far doing that. The other avenue, or one of the other main avenues, is what I did and say, all right, I'm going to go straight to big stuff and syndicate it. And then if I do well with those, I will make a good amount of money on those syndications and then can start moving that into my own properties. And that is exactly the plan, is to transition profits from selling successful syndications into apartments that I will hold very long term. And that basically becomes passive income in the retirement account. So, yeah.
Yeah, that's really interesting because it's a lot of work having investors and doing these deals, for other people. But once you have the money, once these deals, and it's interesting of what, these, 100 million in real estate that we're doing now, it's like, this can be a lot of money someday, when we sell all this, but it's like, you kind of try to, squeeze along in the beginning just to make it work. Cause really you get some acquisition fee typically in the beginning, but it's not a ton, but really where you get paid is at the end. And so
Yep.
being able to roll it into your own deals. Warren Buffett has that saying, the best holding period is forever. Right. The idea of like never selling. I also think though, it's interesting with the value add strategy. And this question comes up a lot with investors is like, well, why do you sell in 5 years? And a lot of times there's a few answers for that. One is that 5 years is like the longest usually most people can see having their money out before they get their money back. Cause that's kind of question number one is, when do I get my money back? Question number two is, well, yeah, that's great. When do I get my money back? And then, but it's also the value add component, right? So you're coming in, you're spending 10K per unit. You're seeing these bumps in rent. Every year after you do that and you've stabilized the property and increased rents, the IRR or the returns actually go down on an annualized basis typically, because
Yep.
you've had this big pop. So you've had, the rents and then the big pop. So a lot of people don't really understand that, like, yeah, every 3 to 5, 7 years, you need to kind of continue to roll into new properties, which is interesting. Mhm.
Well, and also what Warren Buffett is not factoring in is the velocity of money, right? So if you buy a property, you do a value add, you significantly increase the value of it. Maybe you started with $1 million and you're getting a great return on that $1 million, but in reality, now you have 3 million in equity and you're getting a horrible return on that 3 million. So you need to sell the property so that you can take that now 3 million and go get a high return on 3 million. There's some of the and then this is something that I probably would change if I were to go back and do it over again, is most of our deals have been 5 to 10 year deals. But when I look at some of the other sponsors that I know who've done very, very well, or exceptionally well, they did a lot of properties on 3 year hold times. And what they did is they cycled that money faster, and both for them and the investors, right? So you can double money in 3 years, or at least you used to be able to. I don't know if you can do that now, but you could double money in 3 years and then take that. And so maybe you start with $1 million and you're earning 10%, but now you've got 3 million and you're earning 3%. So you take that 3 million, put it into a new deal. Now you're getting 10% again on 3 million instead of, one, and you keep the velocity of that money high. And so your return on equity stays high. So, if you're trying to build a business and build wealth, that's something to keep in mind. That's why you'll see a lot of syndicator deals in the 3 and 4 and 5 year range is because of that effect. But I know personally, I love the idea of Warren Buffett and just buy a property, set it aside and hold on to it forever and just don't worry about having to work. So.
Yeah, sure. That's definitely, there's different approaches for sure. Darius asked this question, what is the advantage to the seller to do seller financing? He still has to pay capital gain tax on the profit. Can you talk about how you structure that in such a way that, they would actually reduce their taxes?
Yeah, and that's part of why the seller in our deal did that, is because we saved them a couple million in taxes. And you definitely want to get the seller to get their CPA involved, and so that you don't promise something that doesn't happen. But what you do is you're effectively structuring it as an installment sale, and so they're only taxed on what they receive in any given year. So if they carry a note for 200,000, if they sell your let's just say they own a property for $1 million and free and clear, right? And so they had to pay something for it. So let's say they bought it for 500 and you're buying it from them for $1 million, so they're making $500,000. But they carry a note for 300. Well, they're only receiving a profit of 200 in that first year, and you're delaying that 300 for future years. And as long as their CPA structures it properly, they only pay taxes on what they receive in any given year. So that's how it can be structured to benefit the seller.
So it's like a structured payment. So you are selling it, but it's structured in a note. So they're delaying some of those payments so they don't claim it. So that's kind of how that typically works.
Well, especially as we get towards the wealth tax. And so there are different tax brackets at different rates and different returns. So if they have, let's say they have depreciation on other properties, so they can annually shelter a certain amount of gain. So if they can shelter a piece of that gain, then they can control what tax bracket they're going to land in. So they're like, hey, you know what, pay me pay me 200,000 a year. I can shelter 100,000 of that based on my current holdings, so that I'm only paying taxes, or I look like I'm only making $100,000. And then that keeps me in a certain tax bracket I'm willing to be with, and it doesn't bump me above that $250,000 mark. So there are tax games that you can play based upon what tax bracket you want to land in intentionally.
Yeah, it's a great point too. A lot of the stuff that I've realized too is you can shelter a lot of taxes through different methods, especially multifamily with depreciation. I don't know if Andrew, you guys use a lot of accelerated depreciation, but I mean, I brought my tax to effectively zero each of the last couple of years, and it's basically deferred or it's just completely written off. So can you maybe touch base? Actually, it looks like we have another question here. Well, just real quick, can you touch base on depreciation and kind of how people do that within multifamily?
Yeah, and then we can address Darius's question. Yeah, so depreciation, if you're syndicating, the depreciation does pass through to the investors, and that's definitely one of the selling points if you're talking to potential investors. Is effectively, for many investors, it's a tax-free investment up until when you sell it, because your depreciation passes through to the investors. In many cases, that depreciation is greater than the income they're receiving. So a lot of times they'll get money from you every quarter, and then at the end of the year they get a K1 that says they lost money, so they can reduce their taxes. So it's definitely a win-win. And so that's how depreciation works. In some cases, you'll want to do what's called a cost segregation study, where they come in, you hire somebody, they come in and they break out all the different components of the property and say, oh, well, these components depreciate much faster. And what it does is it brings depreciation forward. So you take a whole bunch of it in the first year or whatever year you do that study, and then that can shelter a lot of income. The downside is you won't have that depreciation as available in future years. But some investors, they're really, it's really important to them to shelter as much money upfront as possible. If you're buying a property in just your own name, then you can use all the depreciation yourself. If you're a sponsor of a syndication, you're going to be limited to your basis in the property. So if you syndicate it and you have no money in it, then the IRS is going to significantly limit how much depreciation you can take, because basically they're saying, well, you can't suffer a loss. You didn't put anything in. So as a syndicator, it can be kind of limited depending on what you actually put in. Also, depending on the type of debt. And I know this isn't a tax call, so we won't get into all that. But needless to say, there's lots of ways to use depreciation to not only your advantage, but to your investor's advantage.
We got another question here, and then we're going to kind of wrap up here. So if there's somebody's got a burning question, but Ed's saying, I see there's your income.
Actually, Andrew, you said you wanted to jump on
the
question.
So Darius, he just asked real quick.
Oh, sure.
He said that the trick is the installment sale. How comfortable are you not being on title? I would be very uncomfortable not being on title, but the installment sale doesn't affect that at all. The installment sale is basically treated as almost a note. There's a handful of different ways. You can treat it as a note. You can set it up as preferred equity. There's a number of different ways you can do it, but the only thing that might be on title is you might secure that note against the property. So in that sense, it would be on a title report, but you are not changing title in terms of ownership. You still own the property. It's not the seller is not on title as an owner or anything like that. So it doesn't affect that.
All right, then if you want to move on, and hopefully I answer your question, Darius, and Ed's question when you said one next.
Yeah, let's see. So, okay, I can see that as your income skyrockets, you would eventually buy a jet because it would be a business expense. I actually know one investor who did that. What things do you buy or incorporate into your life in the stages before that? I'll probably never go the jet stage. That's not quite my MO. So I don't know if you're just talking about lifestyle stuff or just as far as maximizing expenses to minimize taxes, but there are a lot of things that a non-business person pays with after tax income, that if you start a real estate business, you can pay for those things with before tax income and significantly reduce your tax burden. So I'm not quite sure if you want to clarify what you're asking in there. If I don't know if that answered it or not.
I'll throw a couple out there and let's see if you can clarify it. A good example, I fly to Indianapolis to see my properties. And so when I fly to Indianapolis, I put it on a separate credit card, and that's a business expense. It's a business credit card, right? Because I'm going to see my properties. When I pay for, obviously all this, that is an overhead expense. If I'm paying for a financial advisor, that's an overhead expense to my real estate business. So that would be something that I would have in my real estate business and not have it be directly against my property. So it's a lot like running a regular small business. If you've got travel expenses, eating expenses, car expenses, advisement expenses, professional fees, lawyer, CPA, those are all expenses that would be applied to the overhead of your real estate business and not applied directly to a property. And maybe that's what he's asking about.
Okay, yeah, and we do that too. Yeah, you have expenses that are just general overhead to your business, and then you have expenses that are directly related to a property. So yeah, if I fly out to visit one of our properties, that cost of that flight and that hotel will get billed back to that property at the end of the year, because that's a specific expense of that property. But the software that we use to to manage all of our broker contacts, that's my overhead expense. That's not a property expense. So.
And if you have a business, if you're just doing your Schedule E and you're doing it on your personal expenses, your CPA might ask you to try to apply an overhead expense and put it across properties. But if you have a real estate business, then you can have these overhead expenses that are not applied directly to properties.
So we are out of time. We do have a couple more questions, but
Sorry,
Andrew,
I didn't mean to spend too much
no,
time
it's
on that
fine.
one.
Andrew, do you have time to head over to the Kumo space for a few minutes and answer a few questions?
Yeah, I've never done Kumo Space, so I'm going to check that out.
It's actually a lot of fun.
It's a lot of fun. So it is really great. I've got one announcement to make real quick. I'm going to share my screen here. And so this is going to, just going to share about this event. So we do have an event coming up. This is actually, I just put it in the chat here. This is next month. So there's three guys, Jason Hartman, George Gammon, and Russell Gray are just going to talk about inflation. So each of these guys individually have YouTube videos that have over 500,000 views each. They've kind of done significant work about inflation. So that's going to be 3 weeks from today. And there's the link to the page in the chat there. So if you're interested, that's going to be great. We are not meeting the first week of July for this meeting, but we will be back in August. And hopefully, if everything works out, we will be back in person, which would be amazing. So just want to make a little announcement on that. It'd be a great event. Don't miss it. And then also I'm going to put the Kumo Space link in here. So what we're going to do now is we're going to head over to Kumo Space.
Bronson,
and
just real quick, I did have a question that I wanted to ask Andrew, and I was accused of being a Gen Xer and not speaking up all the time, so that's why I didn't text.
Would you do me a favor, Alvin? He's going to head right over to the Kumo Space, and he's going to be available just the same way we're talking now. Everybody's going to be able to gather. So just head over that little link that I sent over, that Kumo Space link there, and we're all going to head over there. And you can head over there. And actually, Andrew, you want to head over there? And Alvin,
yeah, it looks like I need to copy and paste it into a browser.
Yeah, you just copy and paste it in a browser. For some reason, it's not.
You would do best if you did that.
Okay.
Yeah, I don't know why it's not. I'm going to put the HTTP in there. So you just copy and paste, put it in the browser. You may have to actually shut down your Zoom to make it work.
Because sometimes the camera and audio won't transfer over if you have your Zoom on, and then you bring in the Kumo Space, which also wants to use your camera and audio.
Yeah, and when you're over there, you turn your camera on. So you really want to have your camera on if you have a camera, because it will show. It'll just be a much better experience for you and for everybody there. So if you want to grab a quick drink, this will be kind of a happy hour thing afterwards. It's really fun. We'll head over there, and I'll stick around here for a couple minutes, but please head on over there. And I think Andrew, if you want to sign off and head over, and then Christina, if you want to head over as well.
Head over. Yep.
And then I will just hang out here for a minute.
See you guys over there.
Jump over. Right. So, but thank you everybody for coming today. This has been great. And we'll see you over on the other side here. Kumo Space. I'll put the link in there again. All right. Okay, this should do it. Try that link there. It should work. And so again, before you kind of get it active, you want to shut down the Zoom just so you're not stuck there. So Okay, we just got a few left in here. So the link to Kumo Space is there. If you're still in here, let's see, we got Arthur, Jim, Jay, Jeff, and just head on over to the Kumo Space. Great to be with you guys today, and look forward to seeing you over there. I'll stick around here for just a minute. Make sure you get that link, and we'll look forward to seeing you guys here shortly.